Fannie Mae, credit scores, and the 50-year mortgage. Talk. Fannie Mae just made a move that has everyone talking, and honestly, the headline versions floating around are completely wrong. So let's slow it down. Look at what's rumor, what's truth, and what it actually means for the housing market. Because these changes, or even these conversations, tell you exactly where things are headed. Rumor 1. Fannie Mae is getting rid of credit scores. Truth. They're not eliminating credit scores. They're eliminating the minimum 620 credit score requirement for loans run through Desktop Underwriter starting November 16, 2025. That's the difference. Borrowers without traditional credit or with lower scores can still be evaluated. Payment history, risk factors, and alternative credit data will still be part of the decision. Credit scores aren't vanishing. The hard cutoff is. This is meant to expand access. It doesn't magically erase risk. What this change could mean. Let's be honest. When you expand the buyer pool without expanding inventory, prices don't go down. More people suddenly qualify. More people start shopping. More people bid. We've seen this play out before. So yes, this improves accessibility. But accessibility without affordability just pressures prices upward. And there's another layer. Removing score minimums increases lender exposure. Historically, when lenders face higher risk, they respond with fee adjustments, stricter income guidelines, or overlays. So while the rule sounds like it makes buying easier, you still have to read between the lines. Rumor 2. Fannie Mae is offering 50-year mortgages. Truth. Fannie Mae has not rolled out a 50-year mortgage. This is a national affordability discussion, not a finalized product. There are proposals and comments circulating at the federal level. People inside the industry are talking about it. Media outlets are covering the debate. But it is not approved, not launched, and in some cases, not even structurally possible yet because certain regulations limit allowable loan terms. So the idea is out there, but the product is not. What a 50-year mortgage would mean if it ever happens. It would lower the monthly payment. That's the part they'll promote. But the total cost? It skyrockets. You don't stretch a loan over half a century without paying a ton more in interest. It also raises purchase power on paper. That means buyers can afford more, even though they're actually locking themselves into debt for most of their adult life. That kind of artificial affordability props up higher home prices, rather than addressing the real issue, which is supply. A 50-year loan is not a gift. It's a pressure valve designed to keep prices afloat while letting buyers carry more of the weight. The big picture, what both of these mean for the market. You have two big ideas hitting at the same time. 1. Expand the buyer pool by removing the 620 minimum. 2. Explore ultra-long mortgages to lower monthly payments. When you see moves like this happening simultaneously, it tells you policymakers are trying to create affordability on paper, rather than addressing the underlying issue, lack of supply. It's like stretching a rubber band. It'll hold for a while, but it's still stretching. These changes don't make homes cheaper. They make it easier for buyers to qualify for expensive homes. That's a huge distinction. The real takeaway? People celebrating this as a break for buyers aren't looking far enough ahead. Removing score minimums doesn't change the cost of housing. A 50-year mortgage doesn't make homes cheaper, and none of this solves inventory. It tells you one thing. The market is being supported by policies that encourage buyers to absorb more risk to keep demand alive. Whether you see that as an opportunity or a warning depends on your perspective, your goals, and how long you plan to hold real estate. If you're preparing to buy, invest, upsize, or downsize, you need to understand these shifts because they're not temporary. They're breadcrumbs. They tell you where we're going.